writes about a lot of things. For those of you that haven't had the pleasure yet, I highly recommend checking out the Diff and writes on all things tech and finance. And there's a lot of people that own a little bit of Bitcoin and write about it a lot. And then there's very few people that own a lot of Bitcoin and write about it a little, or have owned lots of Bitcoin at some points in their lives.
That's fair. Yeah.
Yeah. So I I just kind of want to get into it because some of my favorite pieces of yours on Bitcoin, specifically kind of BTC as an asset, have been around this bet of this being a global reserve asset. And that's kind of always been, I think, the honest like bull case for BTC, which is not going to be used for transactions, not going to really be used for daily commerce, but this kind of reserve asset that replaces the US dollar and successfully, fights off the wishes of the strongest, most powerful governments in the world. So my question for Byrne is, how today in 2023 do you think about the risk-adjusted return of betting on BTC being the world's global reserve asset, and perhaps how has that view evolved over the years?
Yeah, sure. So I first I did not realize how long I had known about Bitcoin, but someone actually showed me a link in the Nick Szabo blog that when he wrote about BitGold, the first or second comment is me saying this is stupid, but kind of cool. I've been paying attention for a while, and when I first looked at Bitcoin as an actual investment, this was like right after Coinbase launched. The basic, I think at the time it was like $12. So at the time you could just say like this is a lottery ticket, like there's this very, very low but non-zero chance that this is a better reserve asset than gold or the dollar. It has all these problems with it. On the other hand, the dollar has these well-known problems, gold has its well-known problems, and you can sort of look at Bitcoin as it was originally designed and say that if someone were to look at what gold does well and then look at how you can turn that into something that you can count on a little bit more and that you can model a little bit better. Like one of the nice things about gold is inflation is very measurable. It's very hard for gold production to go up very much, and there's just a whole lot of gold around in the world. So even when gold production goes up, the actual available stock of gold does not change very much. So extremely inelastic. But even better than extremely inelastic is having something where the elasticity is well known. And yeah, if you have a fixed schedule for creating new units of the currency, then you actually have this perfectly defined inflation schedule. So you also have instantaneous transferability, and you have these nice pseudonymity aspects to it as well. So in a lot of ways, it was taking things that were these incidental things that made gold valuable as a store of value, and then saying how can we actually like rederive this other kind of gold from first principles. And so at the beginning, all you really had to do was say, well, I know that the value of gold in the world is really, really high. And if you divide that by the market cap of Bitcoin, you get a really, really small percentage chance. And as long as you think that the odds of Bitcoin overtaking gold are materially higher than that, like if you say, well, there's a 0.01% chance, well, you still get to a really high price target at circa late 2012 or something. But since then, Bitcoin has actually gone up, and I was running those. I ran those numbers, every couple of years, would just kind of check for my own curiosity. And what I started doing was also factoring in the volatility, because if you're thinking about an asset, you want to think about it in terms of what's the excess return over just keeping your money in treasuries, short-term treasuries, and then what's the volatility. And it turns out if you plot a lot of assets on that basis, a lot of things have pretty much the same expected return. So if you buy bonds rather than stocks, you get a lower return, but you also get lower volatility. If you lever up a bond portfolio until it bounces around as much as the S&P, you actually get pretty much S&P like returns historically. And if you run that analysis when I ran that analysis on Bitcoin, um, when it was at like 60K, and I looked at what is the total value of all the gold in the world, and let's just imagine 10 years from now, Bitcoin replaces gold, the numbers were actually not that exciting. Like on a risk adjusted basis, it kind of looked like NASDAQ level returns, which can be good. And certainly if you have all your money in tech stocks, you could diversify into something that also has a like, similar risk return, but different set of risk factors. But yeah, it started getting less exciting around then. Now, if you run the numbers, basically, if you think that BTC replaces gold as reserve currency, has the same market cap of gold in 10 years, you get like a 40% annual return from now to then. And then you're at this point getting about twice the volatility of the NASDAQ. So you actually have this slight risk adjusted edge, but that is in a model where you're actually dead certain that that BTC, sorry, becomes the global reserve currency. And that's obviously not true. But then you have this really interesting question of what does the event path look like? Because originally, the strongest bear case against BTC becoming a reserve currency was nobody treats it as a reserve currency. A reserve currency is by definition the currency everyone treats as a reserve currency. So how do you solve that? And the crypto answer was, well, the more it goes up, the more people will treat it that way. So you start to see this kind of long march through the institutions where at first the only people who own BTC are anarchists, drug dealers. Like there was a time, I think it was 2011 or 2012, where there was actually a BTC price crash because Burning Man ended. And so everyone they had satisfied their demand for the one thing you could actually spend BTC on. Um, but as it gets into more institutional portfolios and not just hedge funds, but also insurance companies and even central banks, then it becomes a much stickier asset and an asset that starts to look a lot more like a reserve currency. So you basically have to up your odds of BTC becoming a reserve currency as the price goes up, which makes it this crazy momentum asset. So you're simultaneously getting more excited that your bull thesis will actually work as the price goes up, but also less excited about how well it will do conditional on that happening as the price goes up. And then the event path you want is BTC rises and volatility gradually declines because once it hits reserve currency status, the volatility is basically a function of the volatility of global demand for money, and that tends to be a whole lot more stable than I think Bitcoin's volatility right now is like 44% annualized. So yeah, global demand for money does not vary 44% annualized. It's more sedate than that. So that's what you want to look for is this gradual decline in volatility coupled with an increase in price. And you often get one of the two. Like sometimes BTC gets boring. There was a while earlier this year where it was actually less volatile than the Nasdaq, which freaked a lot of people out because they want to use it to gamble. Now it is significantly more volatile, but that's the long term thing you want to look for. And so that's how I think about it from kind of this asset allocation perspective of there is it would be very disruptive if the reserve currency system had to change. Those changes tend to take a long time, but when they happen, when they actually start happening, that part is actually pretty quick. Like the decline of the British pound from global reserve currency to the dollar being the global reserve currency, in one sense, starts in the 1890s when the US economic output exceeds that of Britain. But even through the 1920s, London was a bigger financial center than New York. There were still more American companies raising money from British capital than there were Americans who were moving American capital into Britain. So that stuff, like financial centers tend to be really sticky, reserve currency status tends to be really sticky. But once it's unsustainable, people really quickly want to move their money out. And so there's this very rapid period where, and like this happened in the post war, like a lot of the Bretton Woods arrangement was basically how do we allow the UK to gracefully decline as a world power and as a world financial power.
Okay, so a lot there. So I know in other conversations with Byrne, that's definitely kind of the most compelling reason for you to like personally own BTC. I'm curious if there are other value propositions or investment theses for why that are compelling to you on the bullishness of BTC, or perhaps also for BSV other implementations of Bitcoin.
Also BSV. Yeah. So I think that there's definitely room for currency as a kind of software primitive. And there's just a lot of cases where it is useful to have some kind of unit of transactions and some kind of store of wealth. But in a lot of cases, the people who want to use that often have a centralized system already. And Postgres is just it's already there and it's faster than a blockchain. So in a lot of cases, that ends up being the default. Now, where you do want a system that is decentralized is when you want to have something that interoperates across a lot of different platforms, and that I think does have some potential. But then you run into some of the legal and regulatory problems and just the adoption problem in general of if you talk to someone in gaming and you say, well, you can like you're used to selling magic crystals and giving Apple 30%, and you have a business model that works, but you could also switch to Flu's coin or whatever, and it's going to be so much faster and more efficient. Well, now all your users need to get Flu's coin wallets, and you realize, well, everyone who's downloaded my app already has an App Store account, but not everyone has this special wallet. So you end up with an adoption problem. But that also means that anytime there is some use case, and often the initial use case is something somewhat shady. Silk Road was the reason that BTC went above a dollar for the first time, which was big news when it happened. It's like top story on Slashdot for a while. There, like, once there's some use case, once there's some reason for people to actually adopt this, then the incremental adoption gets a whole lot easier from there. So you are building out a network effect that can start with really weird stuff, or just start with people who are fanatical, or even start with people who are in on a meme. Like the meme coins, I think, are just a really interesting collective financial phenomenon, and we see meme stocks as maybe like the broadening of meme finance into TradFi. But the like meme coins as a distribution model for some kind of new payments network is actually a way to get people to evangelize. Like that's been part of the core one of the core economic drivers of crypto is that a lot of cryptocurrencies, they are fundamentally protocols, they're software protocols. Protocols need adoption, and that means they need evangelists. And if you can get paid to evangelize because your token goes up when you get other people to use it, then you actually have a model where people want to adopt a new protocol. If everyone who recommended RSS was getting like $1 from everyone who signed up for Google Reader, and then 10 cents for everyone who those people got to sign up for Google Reader, like, one, you would have a pyramid scheme, but two, RSS would have been more widely adopted more quickly, and it wouldn't be going away.
There's some folks in the audience in the cocktail hour I'd like to introduce you to. I think that are making some of that a reality that eliminates a lot of the adoption things, but we'll save that for offline. Uh, so you know, we're kind of just talking about some of the more bullish aspects of Bitcoin specifically, but more broadly, crypto and blockchain. What do you think makes some of the worst risk reward investments in crypto? And I know there's a lot to choose from even today in 2023, but what comes top of mind when you think about that?
Um, Altcoin is the nice word for some of these things, and altcoins can easily go into death spirals. The downside to being a hyped meme thing is that there's a lot of meme energy in the world, but there's a finite amount, and sometimes it moves from one project to another. And if there's nothing else keeping that project going, then it starts to die. I think you basically, like, if you're looking for what's overdone, what's overhyped, you just want to over-index on what stuff got launched in 2021 by someone who discovered crypto in 2020. There you're going to find like a lot of adverse selection. You're going to find a lot of people who did not learn the lessons of, say, 2017, which makes me feel incredibly old to say this, but there's a lot of crypto history. We've had a lot of cycles. So crypto people age in dog years because there are just so many drawdowns, and so many times, like, the drawdowns are quick, and then because it's decentralized and because so many projects are open source, it's very easy for someone who has very little direct exposure to these assets to spin up a new thing. Like crypto Ponzi schemes, crypto lending projects. They've been around for a long time. Obviously, stablecoins made them different, made them much bigger. But that kind of general concept has been around super early on. Like, you can read ancient Bitcoin talk threads where people are asking how Pirate at 40 was able to produce such high returns, and he's kind of giving hints and telling people, don't ask too many questions about cross exchange arbitrage. And the actual answer was he was paying new depositors out, or he was paying his old investors out of new deposits he raised. And nobody wanted to admit that, but eventually he ran off with a bunch of BTC.
Yeah, no shortage of options for the answer to that question. So, so something you've also written is that there isn't a direct way to regulate a smart contract since the source code doesn't have any notion of what the rules are. Can you speak more about why traditional regulation, from your point of view, is impossible or perhaps very very difficult to apply to DeFi and smart contracts?
Yeah, sure. So when you're regulating, you're trying to stop individuals from making decisions. And sometimes those individuals are doing that on behalf of a corporation, but it's still like there's a person choosing to do something or not choosing to do it. You want to stop them from doing it. And from a regulatory perspective, the annoying thing about a smart contract is that it can do something with no direct human input. And in fact, it doesn't have any kind of built-in concept of something like what's a national border, what's a sanction, what's a tax. It doesn't know any of those things. And so you can write that into the code. You have this big oracle problem where you have to actually have some way for it to confirm that this is an okay jurisdiction, this is actually ISIS, and you can't send them money or whatever. um, and the fact that these smart contracts don't actually have any real world reference does make them really powerful. It means that they're not slowed down by any real world problems, but it also makes them entirely too powerful from a regulator's perspective. Now, I do like you can't directly regulate a smart contract, but that's in the same sense that you can't directly regulate computation. As long as someone can implement a Turing machine, they can theoretically implement anything. People, I think, online like cyber libertarians used to like to point out that technically, if you take any kind of infinite sequence like the digits of pi or the digits of e, you can convert it to a stream of bits, and those bits you can convert to a JPEG. And if you generate enough digits of pi, you can generate a JPEG that gets you sent to prison. And it's pretty trivial to write an algorithm that gives you as many digits of pi as you care to have. So, in a sense, everyone who can do basic math and basic programming is like, in some hypothetical, highly abstract sense, an ultra low probability criminal. Um, Now, of course, that's like a totally pointless argument in any practical terms, but it does speak to the fact that you can't actually regulate you can't regulate compute once people have sufficiently powerful computers that they can build a Turing machine and just like run arbitrary programs. So what you can do is you can regulate people. So the way crypto regulation tends to work in effect is that crypto world just doesn't exist as its own independent thing from a regulatory perspective, but the nexus between the crypto world and the real world does actually exist, and it does consist of actual human beings. They have actual bank accounts, they have IDs. You can send them to jail for tax evasion or whatever. So that's what ends up actually getting regulated. And what I think the mistake that some people make when they are sort of risk on and building new projects and not necessarily aware of the details of all of these rules is they think that because a smart contract doesn't have any concept of what the rules are, because it doesn't know what borders are and it doesn't know what an OFAC list is, that because you can't implement it, you shouldn't care about it. And then the practical answer is, if you build a smart contract that can be used for something illegal, there's a very good chance that the user who is most excited about that contract is someone who wants to do something illegal. And so you kind of have to build that into your assumptions about what part of this do you actually personally touch, what part of it is part of your, you as a US person with a US company. What does that company do versus what tools does that company build that someone can use? You can't really control them, you don't want to know exactly what's being built with them, but you think that those tools can be used to build helpful, pro-social, perfectly legal things.
So I think you wrote that like in 2021. Have there been things since then that you maybe at the time would have thought, oh, government probably can't regulate this or make this stop, and then somehow it happened, whether it was a US regulatory body or something abroad.
Yeah, like definitely some of the, I mean, we'd like to say that code is law, and then it turns out that no, law is law, and code does its best, but sometimes you can be required to disgorge something even if the source code says no. Like a lot of projects do in effect have some kind of backdoor where it can be rewritten in such a way that you undo some transaction that was illegal. So it's been, to some extent, I think the pace of it has been surprising to me. The fact that it happens has not been as surprising. But yeah, I think I underestimated the willingness of the U.S. government to actually force people to disgorge profits from, especially from things that didn't happen really under a U.S. jurisdiction.
So moving away from the US now, again in 2021, you wrote about how crypto resembles emerging markets in many ways. How and why?
Yeah, sure. So this one was really fun because I was talking to someone about this a while ago, and I was talking to you about it. I wrote this in response to Luna, and then I looked at the date, and it was no, I wrote it a year before Luna. But the idea was there was this really interesting financial crisis in the 90s, 97, 98, and it mostly affected Southeast Asian countries. And what happened was these countries were growing really fast. They were export powerhouses, and they would peg their currency to the U.S. dollar. So Thai baht U.S. dollar exchange rate was extremely stable, and what started to happen was a lot of investors from outside of these countries would send money into them because returns were high, growth was there. They could earn higher profits investing in emerging markets than they could in other markets. So a lot of U.S. hedge funds would invest in these countries. A lot of Japanese banks were making loans in these countries. And what started to happen was, as more capital flowed into the country, you have two problems, several related problems. One is that capital has to go somewhere. And one of the places with the most rapidly growing demand is the financial sector. Another is the construction sector. Within construction, it's often office buildings and hotels that get a lot of attention as money is flowing in. So they're basically spending a lot of the incremental money on infrastructure to handle endless monetary inflows. And then you run into a problem, which is for a lot of these countries, their biggest advantage, they didn't have globally recognized brands. They had really cheap labor. But if your labor is being bid up because construction is a booming business and people are getting hired to build stuff, then they're leaving the factories to go to the city and build new office buildings. And so the factories have to raise wages. So as the money flew in, the export driven growth that it was predicated on started to go away. The factories just couldn't compete for that same labor supply, so they started going out of business. And then you have this totally fake economy where the economy is growing because US hedge funds and Japanese banks are pouring money into it. They're pouring money into it because they think that it's growing for fundamental reasons. But really, as soon as the flow of money slows down, it stops growing. And that's exactly what happened. Now, what happened next was these countries all broke their currency pegs. They all went through banking crises. Their banking systems were often totally insolvent. There was a depression in these countries, lots of like widespread unemployment, political unrest, etc. IMF and World Bank came in, told them, "Here's like we'll give you some loans, but you have to restructure your economy." And often that restructuring meant applying a lot of rules that kind of make sense in a developed world context, but don't make sense in a developing world context. Like some stuff that like some norms around corruption, for example, they work really, really well in a rich country with a fairly trustworthy court system, and they work really, really poorly in a country where law enforcement is somewhat spotty and arbitrary. It's actually just more economically efficient to accept that people are going to take bribes. Like the rules are imperfect, and the bribes get around the rules. There's I forget which social scientist had this line that like the only thing worse than a corrupt and dysfunctional government is a dysfunctional government that is perfectly pristine and not corrupt at all. You can't even pay someone to do the obvious thing that needs to get done. It just doesn't get done. So the recovery that these countries had was a lot slower than it could have been. In crypto, we had this same kind of dynamic where as money flowed into crypto, the most lucrative thing to do with it was enable speculation. You're either doing levered margin loans and you're clipping your 15 or 20% or 80% or whatever in DeFi, or you're borrowing on margin and you're paying a lot, but number go up, so you're making a lot too. That stuff crowded out actual legitimate useful projects. So we just had like 50 different iterations on decentralized margin and decentralized market making, and there was just way more money in that than in building a useful app for actual transactions. And then when the money flow slowed down, things started to collapse. Now, crypto doesn't have IMF. The IMF, they did briefly have the SBF, but the IMF has a lot more financial firepower than FTX did, even though he was using more financial firepower than he was really entitled to. So that lasted for a little while. Like for a little while, we actually had this dynamic of there's a crisis, there's a bailout, we move on. But then the bailout bucket was leaky and it stopped working. But the nice thing about that is you just get a total crisis, total wipeout. Everyone who's levered goes to zero and the leverage all goes away. And that actually means that everything has been cleared. It's like like a forest fire where every, the little twigs can start growing back into big trees again. And it restores this healthy dynamic, healthy growth rate. A lot of people have suddenly discovered that they were into AI all along. And the crypto was just a temporary fad. Good for them. I hope it works out. But that does mean that the people who are still in crypto are people who actually believe in crypto. And as someone who does believe in crypto, that's an entirely healthy change, in my opinion.
So, last question for me here. Speaking of belief, so this is kind of like the Peter Thiel question. What is something that you believe strongly or have high conviction in crypto, blockchain, Bitcoin that few others do?
Yeah, I would say that there's this one's tough. Like, and it kind of comes back to some of the stuff I've mentioned before. There's an optimal level of compliance. There's an optimal level of hype and more than salesmanship, which I guess is like fraud. But there's an optimal level of that, and that level varies over time. Now, eventually, if crypto does fulfill its promise, there will come a time when every CEO of every crypto company wears a suit. It's not a suit they bought for a deposition. They actually owned it, like wear it day to day. They will be kind of normal button down people. And these crypto companies will be fairly large institutional companies. They will be utilities. And you don't want your utility run by, like, you don't want the water company or the electricity company run by someone with a really wild personality who loves gambling. You want it run by the most boring people imaginable. So crypto if it fulfills the dream of the product, it will actually ruin the dream of many of the participants. It will no longer be the frontier. It will just be part of the establishment. It'll be an important part of the establishment. It'll be a lucrative part of the establishment, but it will be the establishment. But the converse of that is the earlier you are, the more room there is for this kind of flexibility. Like a lot of projects don't get off the ground unless someone massively overhypes them. And then they try to converge reality on that hype. And now, as long as reality is improving faster than the level of hype is rising, you will eventually reach a point where those lines intersect as long as the available reality somewhere out there does match the maximum conceivable hype level you're capable of. But like the optimal level of overhyping is extremely high early on, and then it declines. Because like these projects, you often need talent, you need funding, you need adoption, and it's hard to get any of those things without having all of them. And it's nice for people who get all of them right away, but usually you have to actually oversell someone on something to get anything started. And this worked with crypto. Like the one of the exciting use cases in 2012 was buying drugs online because it was totally anonymous, untraceable cyber currency, and then turned out to be super traceable cyber currency. Like people, the FBI wishes that there were a blockchain of $100 bills and you could trace who owned which one and where it went all the time, all the way back to the genesis of that bill. That would be amazing. BTC is like it looked like an excellent tool for buying drugs. It turned out to be the single worst currency in existence for buying drugs. You should use any other currency you can find, like even North Korean won or whatever. Probably it's going to get you, better risk reward on your drug transactions. But that overhyping got a lot of people into it, and it turned out that some people were into it just for the drugs. Some people were into it because they were into drugs, but more as a libertarian thing than actually as a drug use thing. So like really into drugs in theory, but in practice, the really cool part was learning what Tor is, and then figuring out like messing up the client the first time and sending a bunch of BTC to an imaginary address. I'm just imagining this kind of scenario. Anyway, but as the system matures, you do end up finding that there is something real there, and that you like parts of it were overhyped, but in the aggregate, like we know in the aggregate, it was fundamentally overhyped. And the hope that is that it is still, sorry, in the aggregate, underhyped. Parts of it were overhyped, and the hope is it's still underhyped to this day.
Okay, well, I definitely think that your point of view on if I wouldn't necessarily use the word crypto, but again, it's all just how you define these words. But I think if leveraging blockchain as part of solving real problems, completely divorced from crypto assets, is successful, you're going to have a lot of people in suits and institutionalized. And I think probably most people in this room today would agree, even though that's not necessarily the dominant view. But that's enough of my questions. So for those of you that have recently walked in, the theme of today is unbounded perspectives. So I've been saying kind of all day, the goal is hopefully everyone asks at least one question of someone on stage. So I think we have a lot of questions we need to get to. So keep them short so we can get in our all 20, 30 questions here. That happens because no, the point of this of today is just making sure that by the time you leave, even if you're not asking a question, you're encountering, whether it's during the cocktail hour, during a break, during lunch, or listening on stage, perspectives that you haven't heard before, and perhaps perspectives that are useful for your business, useful for your portfolio. And yeah, with that in mind, we have a really really incredible writer and thinker up here. It's our last talk. What questions do we have for Byrne?
Bern, thanks for a lot of thoughts there. But I really enjoyed your comparison to the 97 Southeast Asian crisis and the concept, maybe one I'm projecting on your comments of some of these protocols as like crypto economies, not just companies as corollaries. And so um, curious, like if you see particular groups or particular protocols where you think like GDP of that ecosystem is like strong or attractive relative to some of the more speculative ecosystems where hey this is likely to go away.
So that's a really tough one. I wish I spent more time studying specific protocols slash communities because I would have a better answer then. Like I think the general news flow that I saw on Solana based projects was actually pretty impressive. Like people were choosing to build things on Solana, and they were able to iterate fast, and it scaled reasonably well except when it wasn't working at all. So I think that one was one. BSV obviously has its advocates, and is also a case where you can build stuff fast, you can build stuff that scales. And I think part of what you need, like going back to the optimal level of hype and optimal level. There's also an optimal level of fanaticism. And so that is one thing to over-index to, is just the people who like it. If they really, really like it, they will stick through some of the downturns and will keep on going. I think another one that is, I think it wasn't originally crypto, is now more crypto flavored than it used to be, is Urbit. And that one is definitely super smart people. They don't have a hyperactive launch cadence because they are extremely perfectionist, but they do have an ambitious vision, and they're actually building a full stack, and they have a roadmap to implementing that vision. So I think Urbit is the one to keep an eye on. Like they originally pitched it as, this is the programming environment for when programming is as perfected as running water or something. Like this is what everything will converge to. I don't know that that's true, but I think that if you have that attitude of you want to build something that lasts for generations, then you probably will build something that is better, but also significantly weirder than anything else.
Fun fact: there's a ton of overlap, especially in Austin specifically, of the Urbit and BSV communities. I don't know if you encounter that, but a lot of the big Urbit people here are also big BSV folks, and yeah, we get into that a little bit. Thank you, John. Uh, yes, in the back there, green shirt.
Sorry, I had one too. So you can go and then I'll go.
Oh,
You mentioned AI and you kind of digged at it, so I have to dig back at you. No, I'm kidding. Everybody was skeptical about AI until Chat GPT came about, and they were like, okay, this is a viable technology. And now with the economic downturns, crypto and everything is kind of a controversial topic. So what do you think it will take for that same sort of widespread adoption for folks to be like, okay, this is legit, and have everyone start investing, using it, et cetera?
Yeah, so AI, it's been a really interesting story. Like there were, the developments did accelerate for a while, but it was like the demos kept getting cooler, but the products were kind of invisible. And to a large extent, that seems to be true today. Like I think a lot of the AI market cap is actually from Google and Amazon and Facebook targeting stuff better. They probably produce more AI market cap in the aggregate than publicly traded AI companies. I don't know if they could beat OpenAI specifically, but with crypto, it's convenient that basically everything has a token. The token has a quoted price, and so you can actually see the hype happen as it happens. And I think that's really honestly what it takes. Like it's hard for there to be a crypto product hype cycle without a crypto token price hype cycle, and that is unfortunate because of the whole bubble and poisoning the growth story by replacing it with a speculation story dynamic. But you can have growth that outruns that speculative dynamic and hopefully keeps it under control. And one of the things that controls for that is just if the stuff going on is simply too weird for the median gambler to understand and they just don't want to touch it because they don't have any idea how it works, then you can somewhat insulate projects from that problem. And then sophisticated investors will still back it. They will know that at some point the average retail investor will understand this well enough to day trade it with Coinbase, and at that point, the smart investors can sell. So you want people who are kind of predicting the next hype cycle to be backing you, and not people who are trying to ride what they think of as a current hype cycle. And if you look at AI, that's probably the right way that's the kind of bet that would have paid off very well in AI. Like when OpenAI started, it was just an extremely strange project for anyone to do. It was kind of weird that Altman was moving to that from YC. I think a lot of people were just mystified by that decision, and it turned out to be the right move. And it's still crazy how much things were accelerated by just the Transformers paper, and how many people who worked on that paper ended up starting companies or ended up playing key roles in other companies. So sometimes you need something where you're basically waiting for the starting gun that nobody else will hear. Like the Transformers paper, I didn't see it when it came out, but it turns out basically the people who read that and understood it immediately realized things have changed. I either need to work on this or I will get left behind. And if I know that it probably felt too late for some of them, which is like a crazy thing to think about. Like it probably, when GPT-2 came out, it probably felt too late for the smartest people. So if you feel like it's too late and the cycle has moved past you, then maybe that's actually a sign that it's time to get back on.
So this is actually great that she went first because it kind of ties into my deal. So one of the things that came up when George Bush was up there is he talked about how many listed coins there are. I think the number he threw out was 9,000. So in the entire U.S. equities market, there's only 4,300 traded equities. So we're talking double, and it's just coins. And I know it's a log scale, but I mean, how much of that is truly junk? How much of it actually has useful utility? And I mean, I understand that plenty of them are experiments, but there has to be a true culling. And I wanted, like, companies, we have bankruptcy, I don't know enough about the coin market where how many of these can truly hang on until, similar to what you just said, people actually see their utility at some point. And it may be very early on, and most people may miss it, and they may see later even people like this in this room, which is like, this is a tight bubble. Like, this is the top 2% or whatever, 1% of people that are really interested in this kind of stuff. But, there seems to be a great deal of stuff out there that there has to be some weeding out. There has to be, it just seems like a fantastically high number to me when he quoted that. But maybe there is that much utility and I don't understand.
Yeah, I definitely do not think there are 9,000 viable crypto projects in the world right now. Maybe someday, but yeah, not right now. I think the equities comparison is tricky because there are listing standards for actually getting your stock onto the NASDAQ and New York Stock Exchange. I know it doesn't always feel that way, but it is technically true. And if you actually add in the pink sheets and OTC, which is basically the equivalent of the crypto tokens they're technically listed somewhere, they do not trade ever, or if they trade, it's fractions of a fraction of a fraction of a penny, and the total market cap is like 5K or something. There's a really long tail of obscure stocks out there. There's some company that I found where the entire business is entitled to half the cash flow of a stretch of railroad that was acquired by what is now the CSX Railroad Company in 1889. And the business last filed anything with the SEC in, I think, the 90s or something, doesn't exist in any sense except that it still gets paid by the railroad and it still pays a dividend. So stuff like that, you're not going to include that in the list of 4,300 US equities, but it's actually a more legitimate equity than a lot of crypto projects. I think it will probably outperform Dentacoin over the long run. We all loved Dentacoin. It was great. I think they just had a really good PR team, so they kept emailing journalists, and so journalists had the go-to, here's a weird coin, was always Dentacoin, which actually turned into this great marketing thing because there was a while during the meme rush where you just wanted to do the dumbest thing because you knew that every smart person had already heard of crypto, so the only people who didn't know about it were dumb, and you had to model what is the dumbest thing someone could do because that's the only person who isn't already trading crypto, and then you bought Dentacoin. It did really well for a while. So yeah, I think the comparison is tough. If you're trying to name actually legitimate crypto projects, you end up with a short list. You end up with maybe dozens that have active development that does not consist of scammers periodically pushing something to GitHub just to show that they're still alive. A lot of those are kind of convergent or they're a layer on top of something else. So do they even count as one thing, or is it a tracking stock on ETH? So yeah, I think the realistic investable universe for tokens is pretty tiny compared to equities, which is where it should be because equities have been around for a long time and we sort of know what they're for. And with crypto, we know that it can be a way to finance things that the equity market couldn't really finance. Unfortunately, now regulators know this too, and they're applying the Howey test, and you get into weird questions when you start asking, is crypto a security, and is every collectible security, is it a part of security? But unfortunately, the SEC doesn't like exploring the weird mind-melting questions that this brings up. They like finding people for ripping off retail investors, and that has been unfortunately an all too popular hobby in crypto. But a lot of that goes away, and what's left is, by process of elimination, sometimes more legitimate.
So we got time for one more question here. I see Suresh already has a mic, but know that Byrne and a lot of our other wonderful speakers are still here and will be around, for some of the next hour and a half or so with cocktail hour. So, Suresh, why don't you take us home with the last question on Unbounded Perspectives today?
And I'm also a just under 3 years been reading the Diff. Love it. All my friends love it. I was like, dude, Byrne's gonna be there. So kind of a theoretical question about kind of institutional liquidity movement. So when you talk about stablecoins specifically, kind of the main value prop to a bank isn't just that they want to pay each other faster, it's that they want to free up collateral settlement funds be able to do more with the assets that they have under management today. And it's kind of like in a theoretical world where money's moving a lot faster between institutions and much more rapidly, does that have a smoothing factor because on the economy, because banks can monitor and theoretically with blockchain have better traceability, better visibility into what's happening right now and source of truth to react? Or does it just accelerate the, let's say, like arbitrary 10-year recession cycle that people talk about? How do you kind of think about framing that challenge?
Yeah, so I think one way to look at it is like the world like the global economy has just fixed demand for certain kinds of assets. So inventory has to exist on somebody's balance sheet, somebody's going to finance it. And you can actually view things like the rise of just-in-time inventory as this inventory management strategy where rise of just-in-time inventory coincided with growth of consumer credit and with larger house size. So basically, corporate America in the aggregate managed to shift the burden of holding working capital in inventory from their balance sheet to the consumer's balance sheet. You bought a bigger house, you put more stuff in the house, you had a larger mortgage to pay for that stuff and the big house, and suddenly the debt to equity ratio of every company that sells you those goods looks a whole lot better, and they have a better way to manage it. But that kind of growth, it was part of the story running up to the financial crisis, and then it reversed. And part of what happens in a financial crisis is if you have these fixed assets, they have to be on somebody's balance sheet, but you can get some form of liquidity from them, whether it is converting a bunch of uncertain things that have uncertain payback into some kind of securitized product where you don't convert all of it into cash, but maybe you convert 80% of it into liquid cash, and you can repeatedly do that. Well, then the world just gets accustomed to that liquidity being available, and so everyone else sets up their own financing on the assumption of this liquidity. You can actually go back to the rise of the gold standard and to the sort of financialization of the English and Dutch economies in the 17th and 18th centuries, where the Dutch were actually really good at this. There's a really good Substack post, whose name I forget. I think it's called Why the Dutch Did It Better or something. I'm blanking on the name of the Substack, but it was talking about how in the English economy a lot more stuff was done with hard currency, which meant that a lot of people who were middlemen, a whole lot of their job was chasing people down and getting them to pay the receivables. So someone bought something from you, they promised to pay you in 30 days, you have to actually figure out where this guy is, knock on his door, collect your money. With the Dutch, they would actually convert that receivable into a liquid instrument. They would sell it to the bank, get 98 cents on the dollar or whatever. Then they have something that is as good as cash because people treat the bank's obligations as basically cash. And so the Dutch economy was a lot more financialized and a lot more liquid, but that meant it was also a lot more vulnerable to shocks because if all of this credit is created and it's created in a decentralized way, then as soon as any intermediary doesn't 100% trust every other intermediary, as soon as you have some asset that was cash-like and is not cash-like anymore, well, the amount of cash in the economy has dropped. And since available cash is a constraint on economic growth, unless there's high inflation, and in the gold standard world there really wasn't, that meant that the economy was always past the level of productivity that could be sustained under a pure gold standard. It was at the level that could be sustained under a gold plus credit standard, and that meant that growth or even stability was a function of availability of credit. As economies mature, you can actually sustain more leverage, and you pretty much have to because one of the things that's happened with maturing economies globally is people live a lot longer, which means someone needs savings because there are going to be people who retire at 65, die at 85. They have to, money gets spent, they do consume resources in the meantime. So on someone's balance sheet, like on society's balance sheet, there is this liability of provide goods and services to people who are not working. And then there has to be some kind of offsetting asset, whether that asset is net present value of taxes that will be collected on the next generation to pay for the previous generation, or whether it's net present value of output that retirees get from the savings they accumulated when they were working. Like either of those, economically, what they both shake out to is people will work, they will consume less than they produce when they work, they will consume more than they produce when they are old, they'll also consume more than they produce with their kids. It's really hard to get a lot of economically valuable labor out of your kids, unfortunately, although I've tried. So you have this, over your lifetime, you have this point of negative savings for society, positive savings for society, negative savings for society, and as long as what you average out to is some sustainable level of consumption, then everything is fine. And
One way to handle it is in a very decentralized way, and the way most modern economies handle it is through central banks that try to adjust the availability of liquidity specifically in response to those kinds of shocks and in response to expectations. They do a better job actually of adjusting to the immediate incremental shocks than they do to adjusting to just real world changes in productivity expectations. And if they get those wrong, if they think the economy can do X and it can really do 0.99X, well, they'll provide enough liquidity to buy X worth of goods, but if there aren't X worth of goods and services being produced, you just get inflation. And I've heard that happens sometimes.
Okay, let's give it up for Byrne Hobart, everyone.